Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kostrup-Larsen.
Welcome back to the latest edition of Top Traders Unplugged, where each week we take the pulse of the markets from the perspective of a rules-based investor. It's Alan Dunn here, sitting in for Niels again. Niels is off on his travels again, and delighted to be joined by Katie this week. Katie, how are you?
Great. Nice to chat with you today, Alan.
Very good. Yeah, looking forward to it. How's all in the Boston area? Are you getting ready for Christmas, or how's the holiday season?
Yeah, I mean, honestly, it's been really cold here. So I just kind of always hits me in December and I say, oof, what happened here? So we're definitely in full swing for winter here.
Good stuff. Yeah, well, somewhat similar here in Ireland. We always like to kick off asking people what's on their radar and what's been keeping you focused in the last while.
Well, I think, it's been pretty quiet in the markets, but, I was trying to think of what are some of the fun market movements that I've been watching? And I think reading that Quantica paper that we're going to talk about today and thinking about commodities, honestly, coffee, cocoa, and some of these sort of baseline mocha latte trades that just the price changes, it's going to make it a rough winter season with those expensive lattes.
Absolutely, yeah. I mean, as you say, soaps have started to move again. Coffee up to new highs for this move. So yeah, I guess we're going to feel that in our pockets soon enough. I don't know if they'll start. What do they call it? Shrinkflation. Will it start cutting the size of the? I suppose the coffee is mainly water, but yeah, I don't know if they'll start cutting the.
Well, maybe we'll have to switch
is.
to green tea or something. I don't know.
Maybe.
We'll have to find a substitute, who knows?
Yeah, well, let's just say we've started to see some interesting moves in the softs. And so maybe that's a good segue into performance. We can talk about performance before we get into the main part of the conversation. So in terms of monthly performance, the SocGen CTA up 1.7% month to date, and the SocGen trend up more or less the same. And on the year to date, both up just under 3%. So hanging in there as nearly as a somewhat positive year. And obviously this month has proven to be reasonably positive. We've seen breakouts again in coffee and in cocoa. Equities have been trending hard, particularly European equities. We've seen renewed momentum there. And elsewhere, I guess on the fixed income side, still somewhat choppy. And on the FX side, some of the currencies like the euro have been under pressure. But in terms of this month, anything standing out to you, Katie, in terms of performance?
Yeah, I mean, obviously what I'm seeing is the currency trade is the biggest one this month. I mean, it was interesting. Yeah, because last month, everyone was talking about that Trump trade, right? So the long equities, long dollar, and maybe a little bit of short and fixed income. And this month so far, the biggest mover and thing to watch out of all that trade in November really has been currencies. So, I'm definitely seeing that has been the more consistent move. I mean, the dollar has been very strong. So, not usually currencies in trend, but, when they work, it's exciting. So
yeah, no, for sure. And it's, I guess, where the attribution has obviously shifted through the year, which is often what we see in managed futures. And I know you've been doing some work kind of reviewing the year, and you're kind of in the midst of writing or preparing to write something, so reviewing 2024. So, I mean, taking a step back, what's your perspective on 2024? As I say, it's been kind of a flat to slightly positive year overall. What would you say are the main takeaways?
Well, so we've been working on this paper that we're going to publish in early January, obviously because we need all the data, but the data's not in yet, so we're waiting for that. But the title of the paper is Themes of 2024 right now. Slow and steady wins the race. And so I think that kind of sums up something that was really interesting that we noticed. So when we looked at, the year in review, it has been sort of, in some sense, a false start and a reemergence by the end of the year. So Q1 was, guns blazing. It was phenomenal quarter. Like it was, you had equities up, you had commodities doing well. And then honestly, Q2, Q3, a lot of back and forth related to monetary policy. Then Q4, the relief over the election. And now you're starting to see some trends related to sort of changes across different global regions, and also this sort of pro-US kind of theme that has emerged, especially in the last 6 weeks. So, it was a difficult year for trend, but certain types of trends really work. So, one thing that we do, which is super interesting, and I've been a big fan of it since, some of my early work with Alex Grazerman, even in our book on trend following 10 years ago, about CTA style factors. And what these CTA style factors do, and I know you're really familiar with them, Alan, is they kind of take a plain trend system and then they perturbate some of the design decisions within the system to isolate a factor of decision in terms of how you build your system relative to a trend benchmark to create CTA factors to help us understand sort of relative tilts in design decisions and how those perform from a year-to-year basis. Can be very helpful for understanding return dispersion across the space, and also sort of understanding which tilts, work when and how. And so I'll just mention these 4 factors that we usually talk about the most. One is our speed factor. So are you faster or slower than your peer set? Secondly, the size factor, and it's very similar to, our classic size factor in that, like, how much do you allocate to smaller versus larger markets? Then you also have your co-movement factor, which is inspired from our friend Nick Baltus, and it's defined in exactly the same way as some of his papers. This is meant as a proxy for crowded trades. And then we also have the correlation factor, which is how much do you lean into less correlated markets versus more correlated markets? So the dollar versus like the Mexican peso, for example. So let me just tell you what we saw, which is pretty exciting. And we always like to look at this because what's important is each year is very different because trends are so idiosyncratic. It really depends on what trends came about this year. And something stuck out really quickly. Slow minus big was massively different. So slow systems had very highly positive returns, and faster system signals had much, much worse negative returns. And this was true across all asset classes. So that was kind of shocking that how big the divide was this year. So it means like you just look at the long-term trend at the beginning of the year and stuck with it. You've been avoiding all of the noise from monetary policy, which is awesome. Then the other 3, and I'd love to hear your thoughts on it once I tell you all the results. The other 3 were less notable, but large markets perform better than small markets. And this was particularly the case for equity indices, as well as fixed income. So, but mostly equities. And what that means is like, if you stuck to the S&P 500 and the NASDAQ and the highly liquid markets versus more esoteric ones, that helped. Co-movement and correlation didn't do as much this year. So in certain years, they are really important. I expected a little bit of that from the commodity sector, but some of these esoteric commodities we talked about before, they're just small, so they may not have a huge impact on the overall portfolio.
Yeah, interesting. Yeah, I guess what you say makes sense. I mean, from my perspective, it seemed that a lot of the dispersion was driven by different positioning in fixed income in particular related to speed. So I remember like coming into last year, some managers got long fixed income, I think maybe in December, and did well then, but then did badly in January when the markets reversed, and others would have been slower to reverse. And we have had a lot of flipping in fixed income, haven't we? At the start of the year, inflation proved to be, well, coming into the year, there was the kind of the expectation of rate cuts, and then we had sticky inflation, and then we had recession fears reemerged during the summer, and then we had the Trump trade. So it's kind of flipped back and forth 4 or 5 times. So it is no surprise there that speed factor. I think in our group conversation, which we'll give a quick plug for, that's coming out soon, you mentioned the magnitude of the dispersion at 10 vol. It seemed quite large. What can you say that what it was?
So if I look at the dispersion across managers, I have a plot right in front of me here, so I can take a look at it. I don't think it was exceptionally larger than sort of certain years in general. You saw a lot of dispersion in Q1. So some managers were up a little and some were up quite a bit. You saw a lot of dispersion in Q2 and Q4, but a little bit less in Q3. I think you actually hit on something we also pointed out in what you were saying is as we looked at our trend systems across each asset class, across windows of time, there's a big asymmetry in fixed income. So anything in the shorter term around 6 months or less really struggled in fixed income. So you can imagine that 6-month time horizon, it's just getting whipsawed by exactly what you said, this inflation worry, and then boom, recession worry, and then are we cutting or are we not cutting? So the longer term signals did better in fixed income, say 10 months or more, around that horizon. But generally, most short term signals had a lot of volatility, and fixed income was probably the most affected by that.
And in terms of the markets and market size, I mean, obviously some managers seem to very much benefit from the cocoa move in earlier in the year. Is it a bit surprising that doesn't feature more in the size factor?
Yeah, I think that made the size factor a little more mixed because we obviously look at it by asset class. So you do see actually in the correlation factor for commodities was positive, and that kind of might suggest that like less correlated markets did a little better, especially for commodities. So things like cocoa, coffee are much less correlated than energies and metals. So we do see a little bit of that in there, but I think from a whole portfolio perspective, it's going to depend on how much exposure a manager had to cocoa. And I think it varied. But I did want to point out one other graph that's really interesting that we were looking at, and this is why I love the CTA style factors, because my history, like yourself, of being a CTA fund of funds person many years ago. Why I love these factors is we applied them to all the managers, the biggest managers in the Morningstar category and ETFs. And it was actually, and we do a bivariate regression where we just look at the coefficient for the speed factor for each of the managers across the space. And the reason the return dispersion matters here is you have managers who are down like 5, and you have managers up 10 or more. And so you have that pretty wide range. I can't say statistically if it's more than historically, but it's definitely what investors typically get concerned about is like, well, one is up a lot. Does it matter? And when we looked at the regression outputs for speed versus performance, it has a remarkably good fit to sort of what you see. And so what you see is a lot of managers who, have a dedicated allocation to faster signals and are trying to really capture that crisis alpha and, get there versus some of the ETFs that focus on replication and sort of slower moving signals. The difference between those two could easily be explained by sort of the tilt in speed and how slow just was so much better this year. So I think that's important for investors just because depending on your objective, you could have a very different year next year if we had a recession or something, an event. And so I think it's a balance over time of, reactivity is important in trend, but each year is different.
Yeah, interesting. And you mentioned correlation being one of the factors as well. I don't know if you look at it, when you look at correlation across markets this year, anything to observe on that front? Have they been more or less correlated than usual, would you say?
I would say, when I like to look at correlation across asset classes, and I think that's probably a big driver. And, frankly, for the last 2 or 3 years, because inflation has been a topic that's coming up, you are seeing a lot more cross asset class correlations that are varied. And I think that has created some challenge for fixed income because fixed income has been sort of positively correlated with equity sometimes and then negatively correlated other times. And it does make that, that trickier, I would say.
Yeah. Okay, so it sounds like conclusions for the year, slow and steady won the race. Just because you did well this year, or if you did, and being the slow manager may not be the way it'll play out next year, but we shall see. And in terms of course, the other thing you mentioned was within equities, and obviously makes sense. Larger markets, the S&P 500 has been, okay, the Nasdaq has done better, but the S&P has had a phenomenal trend. And if you can contrast that, I guess, to some of the other equity markets, like European equities rallied in January, but then kind of did nothing for the rest of the year. The Hang Seng went down and had a big spike, then kind of disappointed. So easy to see how some of the other equity markets have been choppy. And, I suppose if you were a slow trend follower, heavily focused on the S&P, you probably did quite well this year. I don't know if there are many CTAs like that out there, but if that was your construct, yeah, it would have worked well.
It would depend on how many markets you trade too.
Yeah.
And I think that's the thing is like for a smaller market set, if you have, 20 or something, you definitely have a tilt.
Yes.
To the bigger markets. And, it's just a different strategy in my opinion. So, I love CTA style factors. They're like my favorite thing.
It's always great for conversation and analysis. Yeah.
It's just a good way to kind of think about the different designed decisions. And it gives us a chance to kind of look at a year and say, okay, these are the styles that worked and, who has those styles and why and in which asset classes. So they're a lot of fun. So I'll probably keep writing about them for a long time.
Absolutely. I'm sure investors will be keen to read your paper when it comes out in January. Now, you mentioned ETFs, and there was some interesting news recently on the ETF front. What was that?
Yeah, I think people have been chatting quite a bit about a filing by BlackRock to launch a managed futures ETF. And I know it's obviously still early days, but, it kind of is consistent with what we were talking about back in Stockholm as well in my former home place. Just this, just the ETF space and how it's really becoming more mainstream, especially as you have more and more players entering the marketplace. I know Niels and I talked about this paper that we wrote, which is great for anybody who wants to read about this, called The Managed Futures Ecosystem, the Rise of the Managed Futures ETF. And what we're kind of explaining here is like changes in US regulation have really made active ETFs a much more viable product structure. And we explain, and what's exciting to me is like we explain how, with any new space, there's different phases. There's product proliferation, then there's innovation and consolidation, and then maturation. And so we saw that in the mutual fund space, and I'm excited because I feel like this example is just another example of product proliferation. And so, kind of it's a space where BlackRock getting into the space is just a sign that, this is a space that could have a viable allocation in a disaggregated U.S. pension fund world.
Yeah. And have you heard or read any more about what's the nature of the managed future strategy they're running, or the personnel going to run it?
I don't know much about that yet. I think we will find out. Obviously these things, there's a window of time, but for me, it's more just a saying, hey, there's a lot of people that see this space as a place to be. And, it's a very, very different set of investor. And, I think just given the structure of the U.S. pension fund system and how few people have access to managed futures, I think that's exciting. So.
No, for sure. Yeah, no, definitely will be interesting to see. And also, is it a replication route or not? I had a quick look at the filing that was sent around. I didn't see much mention of replication, but equally, the people involved as PMs seem to have mixed backgrounds, some equities, some kind of income. So it will be interesting to see what the final product looks like when it emerges. But you also mentioned that you were in Stockholm recently, and you were with all of the great of the managed futures industry at the Hedge Nordic Roundtable, and they've just published their summary of the conversation. How was that? What were the interesting themes that you took from it?
Well, it's always fun to go back to Stockholm for me. I love it. It was a fun conversation. I really enjoyed it because, first, one theme that I think that I have seen, which is consistent with what we just talked about, is, the year before I was at the same conversation, and myself and Otto van Hemert was there as well. And we were talking a little bit about ETFs. And, this year it was exciting to see that the conversation was actually much more extended, and there were more views and more people talking about that. So that's just another example of how this is a new exciting avenue for managed futures, although very, very different than, your classic manager space. Whereas, we tend to see that there are just different products for different people, and there's different wrappers for people, and we're excited about both. And we think replication is an exciting way to get exposure, but we think about combining it with bottom-up approaches like direct implementation and risk management. But, so I was excited about that. And then there was a lot of just, kind of talking about dispersion as well, just because, obviously you saw varied results this year. And I think people are just trying to understand, like, what are the big risks going forward and what are the opportunities for trend in 2025? And sort of, how could markets actually navigate next year, I think was another thing we were talking about as well.
And anything in terms of looking ahead to next year, we've had a kind of couple of up and down years. Obviously 2022 really good, 2021 for some managers really good. I think if you took the 5 years to, or at least the 4 years to the end of, say, September 2022, was exceptionally strong for trend following managed futures, and things have kind of tapered off last couple of years, been up and down. Was there a sense of optimism or not in the room, would you say?
I think there's some optimism, especially now, because I think, you know how it is. It's like trend goes through periods of consolidation, and then it goes through periods that, of really finding incredible trends. And I think I always believe that trend is a strategy that likes macro change and stress. And frankly, if you look at last year, the typical equity investor, especially in a US one, is not so stressed. They had volatility, but things still look very good. So I think, for us in this space, it goes in cycles. It's really about, what kind of key things, and change always comes. We just can't predict exactly when that will happen. So it does feel a little bit like some new trends have kind of emerged recently, and that this dollar trade, the US versus, other, has some legs, but, of course, there's also risks. There's, policy mistakes. There's, geopolitical conflict that could get in the middle, and trade conflict. So there's a lot of room for turbulence, and I like that.
Yeah.
So that's what we like. Yeah.
No, definitely. And I saw a chart somebody was posting, a macro strategist, like sentiment in the equity market at an all-time high, or like in relative to recent years, and some notable bears capitulating on their bearish views, which is always a kind of a warning sign that maybe things are getting really over exuberant. So I think that's obviously we've had a very persistent rise in equities and hard to stand in its way, but you've got to think at some point we'll see that tested and see some more turbulence there, not without timing it, but you'd have to expect that'll be a feature of the landscape at some point.
Yeah, I think so too. But it's always so shocking. I thought that last year.
Of course, yes, I know. Yeah, exactly.
But you must agree, Alan. It's so funny being a trend follower, because it's like you always think that doomsday's coming,
yeah,
right? Because you're like, oh, it could, things could get wild, and they eventually do. But that's why I think we're interesting to talk to, because everyone else is looking for a bull, and we're looking for a bear. So, it's always good to ask us what we're worried about, because sometimes they come to fruition.
Yeah, no, for sure.
Yeah.
Good stuff. Well, maybe good to move on to one of our main topics. And again, from our good friends over at Quantica, who have been a great source of materials for us to discuss on Top Traders Unplugged. And they have a paper out recently on a topic that has been has a long history of debate on Top Traders Unplugged as well, isn't it right? So it's on volatility sizing, but they've done a really good job of framing the debate and looking at some historical data around that.
Yeah, that was a great paper. Great bedtime reading, right, Alan? They're like, ooh, position sizing. Or maybe not. You might have too many dreams about position sizing. But yeah, I read the paper and I was so excited, because I love a really clean research paper on something like this, which makes a point, which is interesting. And, what I loved is they kind of address the age-old question of, okay, if you're going to trade a trend, do you sort of buy a certain number of contracts and hold it out to a certain level? Or Do you sort of buy it and then size it as volatility increases to kind of like manage your risk over time? Like that's sort of the classic CTA question, right? And what I love the most is how they also looked at sort of volatility. And they kind of looked at sort of what was the ratio of volatility entry to exit point for a full trade, for any of the trades that they looked at over a 30-year period. And it was only 1.05 for, ratio of increase in volatility for sort of losing trades. But they found that the winning trades had a volatility ratio of 1.2, and that the winning trades for trend, the top, big hit it out of the park trends had, with that, the highest increase in volatility. And this is endogenous, right? Like you and I know this. Like obviously if a trend with profitable, the volatility is going to be higher, but sort of the relative differential between those two was interesting. And I got all excited because I started thinking about how many people in my career have asked me the question, how is managed futures similar to volatility? And they didn't talk about this in the paper, but if they were here right now, I'd ask them about this. It's like always people are asking me, how is managed futures similar to long vol? And, if you look historically, I've written a couple of papers about this, there's like a 20% correlation, and that's just a ballpark between managed futures trend and vol. And what could have been cool for them to measure is like, what is the vol correlation for a static portfolio sizing versus dynamic? Because I would guess, because they show this, is that dynamic volatility sizing is really its benefit is risk management. It's sort of reducing the over concentration of your portfolio to those few cocoa trades. And so I think if you looked at the vol exposure, a classic trend with static position probably has a 40% or higher correlation with long vol. And so there's there's just a very great pure play example of how we are exposed to long vol, and that long vol is often a very desirable characteristic for many investors who are looking for risk mitigation.
Yeah. No, it's interesting. I mean, as you say, that was one of the interesting features of the paper, is that how they measure how volatility changes in the trades, the trends they get into, and how volatility tends to rise in the profitable trades. And that's something we intuitively know. And it's one of the great features, like an attractive feature. If you can get into a market at low vol with a big position or a decent sized position, and then the volatility expands in the direction of a trend, and that's great. Obviously by vol sizing, managers manage risk. I mean, one of the things I noticed is that, because I was thinking, I wonder then, is kind of as you're saying, if you look for markets where volatility expanding, is that a signal by itself? But I guess one of the things that you see is volatility expands, but then it tends to expand even more under reversal. So if you look at, say, the cocoa trade and look at the realized vol in that market, yes, it did expand as it went up, but then it really expanded, like it went from, say, I think 20% annualized vol to 120%. It hit 120% when it started to turn down from the peak. So, and that's part of the justification for the volatility sizing, isn't it? Because intuitively the argument is that you tend to get more volatility as you're hitting the turning point, and you want to manage the risk. So curious to get your perspective on that. Is that why you think? Would you agree with that? Is that a reason for the vol sizing?
I think so. And I mean, I think what I also started thinking about based on what you're saying is, when I was reading the paper, I was thinking about, I liked how clean cut they made it, that it's, just dynamic volatility sizing or static. But the truth is, the way that you measure your volatility will also matter. So you can actually think about this as a spectrum, right? So if you thought about the static as if you treat the volatility as irrelevant, and the dynamic is like you're moving with it a lot. So maybe, that shows the art as well of like, where do you hit on that spectrum? Because you're right, you pointed out that the volatility isn't just in the up, it's also in the down. So that's where some of that risk management comes in, is that, although you want that upside of that huge trend in cocoa, you also kind of benefit from less exposure to the high volatility and reversal like behavior of trends when they go overextended.
Yeah. I mean, it's interesting. This has been a topic that's been debated by lots of people on this podcast. And but reading it again, it was it's kind of interesting because even if you look at the results, it kind of proves what everybody is saying in a sense, because people who do volatility scale and rebalance all the time, they'll say, well, by doing that, you get a better Sharpe ratio. And that's what the quantitative data proved. And kind of advocates of not volatility sizing and constantly rebalancing say, no, forget that. We're not looking for a higher Sharpe. We're looking for a higher absolute return. And the data proves that as well, because you did get a higher return, albeit with higher vol and a lower Sharpe. So it kind of like it didn't kind of settle the debate. It kind of proved that both perspectives had validity. Isn't that fair to say?
I would agree. And that's why I like the point of it depends on how you implement it too. Because, if you have really, active vol scaling, then obviously you're taking more profits. You look a little bit more and more about risk management. Whereas if you had a slower volatility window, and this matters, especially when you think about slow systems or replication, these things matter because, you're actually much more in the middle of the spectrum, I think. I think people make different choices depending on how they measure volatility, and how reactive their system is will put you different points on the curve. So I think that was something that I also think about from a practical perspective, that, this implementation can vary as well. So, but it was a great paper to kind of say both of them are right.
Yeah,
So,
it is. But
yeah.
I think the issue of concentration is interesting as well, because I think it comes to like a different. I think that you've nearly got two different philosophies on trading here. Like one philosophy is very much kind of a portfolio manager statistical perspective that, why would you want to have more concentration in the market that has, where volatility has spiked up and has trended, versus another market which is trending but hasn't shown that volatility expansion. So from a kind of statistical perspective, there's no reason why you'd rather have more concentration in the first market. But kind of the classic trend follower viewpoint, and hopefully I represent it accurately, is you do want to have that concentration to capture the possible outlier. So it's kind of a different mindset, a different philosophy. They're both kind of trend followers, but there seems to be a different philosophy underpinning the two styles.
Yeah, I agree. And I love that because if, a lot of the things I've always been so fascinated with trend following as a strategy is it's really a behavioral strategy. And they also pointed out in the paper just sort of the hit rate. And that's something that a lot of people don't realize with trend. And when I explain this to investors, it kind of it's sometimes an aha moment because they think, how is it possible that like everything trends all the time? I'm like, no, there's just not that many things that trend or that often. But when they do, if you have this strategy, you capture most of your, it's that positive skewness, right? That sort of bang that you get from cocoa, which you don't get this year from, say, I don't know, aluminum. Just picking a market. But so I think that sort of is a very different type of hit rate than most investors think about when they think about equities or value and things like this. And so that's where the philosophy comes in and, kind of these are trends that are extremely profitable but rare and not 50% of the time. And so it's about how you manage those rare trends. Do you manage them to kind of capture the most return, but, put yourself vulnerable to extreme reversals? Or do you kind of say, look, we want a smoother ride and we want to capture a good part of the meat of those trends, but we also want to balance our portfolio to kind of be a little bit more risk managed. So I think that was a great paper to
I think so.
think about that.
And I think, that was one of the things that, this is like from speaking to investors over the years. It is one of the big bugbears, if trend followers make a bit like this year, if you make 10-15% in Q1, but then give it back quickly, it tends to annoy people, so you might say, well, that's just the way it is. But this is where the behavioral challenges come in. And do you want a smoother ride for investors or not? Or do you just say, no, we're in this strategy to capture those occasional moves? And like the reality of the move we've seen in cocoa is kind of, probably not something we've seen in 20 years, but are equally, they showed a cocoa example, but actually the move in interest rates is even more extreme. Like if the volatility expansion that we saw in say the SOFR contracts or the 2-year note is a even greater multiple. So, I mean, these trades, they come along, but you have to be very patient. So the behavioral side is another aspect. And I know we were talking beforehand about the bits that we wanted to ask Quantica that they didn't mention that one of the things that I don't think they went into is like how the different styles blend with equities or blend as part of a bigger portfolio. I'd be curious to see that result. And obviously,
and also the skewness.
The skewness was the other point I had.
Skewness.
Yeah, exactly. Yeah.
Yeah. Yeah.
So curious to see that as well. So, and also, it is, this study was done over 30 years, 1994 to 2024, I think, or 95 to 2024. It's a long period of time, but, if you're searching for outliers, presumably you are searching for quite infrequent. So in another 30-year period, you could have more outliers, and the results could be different. So, I think the debate will rumble on. Any other takeaways, or I mean, would it force you to reassess your perspective on constant revol sizing your book?
No, I mean, I think it rhymed very much with a lot of philosophy and things I like to think about when it comes to trend, is that, sort of the trade-off between sort of position sizing versus capturing those trends, I think, is something that all managers have to think about. It just was a really eloquent way to discuss that topic, and I also got me thinking about like extensions of it, and I think that's great. So applause to them for a great paper. And also for sending it out, what was it, Wednesday night or something? I said, a couple of days ago, and I was like, Alan, this is great. Let's read it. So, yeah. So something fun for us to read, before the holidays.
Yeah.
So, yeah.
And I mean, you touched on the point about long volatility, which is, it's always a topic that comes up in conversations. And then you've got kind of, are you long implied vol, or are you long realized vol, and variants like that? I mean, is that a topic? When you get those questions from investors, is that people seeing that as a favorable thing or not?
No, I definitely see it as a favorable thing. This is a topic that has come up for me for 15 years. And I actually wrote a paper for CME Group in 2011 on this topic, or 2012. And it's just kind of like explaining that, managed futures isn't explicitly long vol, but we do have residual long vol exposure, because when things trend, the volatility tends to have expanded. So we're sort of tend to be in positions where vol has expanded. But this paper kind of hints at the point that, depending on your position sizing approach, you might have more or less of that long vol exposure. And so it depends on what the objective of an investor is. If an investor is looking for risk mitigation, and they're looking at sort of like, I just like the first one example, they want returns when, maybe they can get more correlation to the long vol, if they have the static, if they're willing to understand the risk management implications, and think about global sharps more than, say, local sharps. Or maybe they need a mix of the two, which is what I was saying, a little bit of both, to kind of balance those two risks. And on the other hand, as you move to more aggressive position sizing, you're capturing that, but in a more better risk-adjusted way. So I think that, kind of answered a question for me that I explained in that paper 15 years ago, but it was much more explicit and showed it kind of, in a neat way. So I would love to ask them about that.
Yeah. And on the concentration issue, I mean, there is also the point, if you're a discretionary macro manager, like, concentration is a good thing sometimes. If you have a high conviction trade, you just lever up, you know what I mean? Like, that's it. You don't want to have a load. You don't want to have a balanced book with 10 positions. If you have a high conviction on the dollar, that's where you want to have your risk. But obviously, quants don't necessarily approach it the same way. But I mean, what they showed, in the paper, you could have quite a concentrated position in a sector or market, obviously, by just leaving the position to participate in the rising volatility. But equally, I guess, even if you're vol sizing, you can be concentrated on a risk factor sometimes. As you said, inflation was a big driver. Effectively, most CTAs kind of were effectively short bonds, back in 22 as the main risk factor. So how much is being heavily concentrated? Is that, how much of a concern is that?
So this is a really good philosophical question, because, I think that one of the big challenges, trend following, I think as a strategy, one of the big challenges is that when you look at it across a portfolio, it's really exposed to prevailing market macro themes. And so endogenous in this is, the correlation structure of those themes and sort of the stability of those themes. And so this is something that's been a challenge, especially clear to us over the last 2-3 years, where a lot of the overall volatility profile, correlation profile has been really focused on monetary policy. And that's why I said when changes in correlation between stocks and bonds, that's driven by sort of the fundamental relationship between those asset classes. It is driven by this overall macro theme of, do we have inflation or not? I do agree that sort of you get a different type of concentration. The concentration you're getting is perhaps more sort of a balance of those macro themes, and you're really exposed to a multi-asset macro themes where that's actually your position instead of individual trends themselves. So those individual building blocks build up to something that really is a macro themed exposure based purely on price movements.
Yeah, no, I guess it's true. Yeah, I guess one can be managed and the other one can't really. I mean, if it's just one dominant factor influencing all markets, there's not much that can be done about that. And then obviously some of the best periods of performance for trend following tends to be in those periods, like global financial crisis, or we saw again 2022 when markets do tend to get quite correlated.
And actually, Alan, you would like this example. Like one of the coolest things an investor said to me during 2022, which I really appreciated because you talk to a lot of macro people, is that they said, we love macro. We know macro is really important right now. We know the markets have changed, but it is so hard to determine who's going to call those things right. And it's so hard to time central banks, so hard to do all these things. And why we like to use trend following is it's sort of a systematic approach to get that macro exposure without having to make all the macro calls. And I thought, that's a genius way to explain it, in that we end up in all the macro positions. And therefore, if they're big macro change, we tend to do well. In a year like this year, where basically it's all about, will we actually have cuts or not, back, forth, there hasn't been a lot of macro change. So it's not surprising that, that hasn't been an easy macro environment in general for trend, especially in shorter time horizons.
No, for sure. Okay, so maybe moving on, there was another paper that came across our desks that was interesting and definitely topical. It was from Aspect Capital on the whole area of portable alpha, and that's something we've been talking about on Top Traders Unplugged a bit recently. And portable alpha is the idea of combining different strategies, so combining an alpha strategy on top of a beta strategy, such as the S&P 500, and getting the S&P 500 exposure, say, you can get either side of it kind of via on a leverage basis, but one way of doing it is to use futures to get the S&P, and then you have capital freed up to invest in an alpha strategy. And this is similar to return stacking. It's effectively the same thing. I mean, that's been a popular label put on it in recent years. I mean, portable alpha, it seemed to be very popular going back to pre-global financial crisis days, and then kind of died a death a little bit. I wasn't as close to portable alpha strategies back then, but my impression is that they were more, you were combining equities with another equity strategy, which wasn't very sensible. But have you had much exposure to running portable alpha, or what's your perspective?
Well, obviously it's something I'm quite familiar with, but, I generally think the framing of that question can be a little bit confusing, because I do really believe that when you say portable alpha, you're kind of assuming that those correlations hold. And you're kind of ignoring, and I always love that, with the APT and the CAPM, and I used to teach those things to MBAs, and I always thought about it like, when you have an alpha, there's always still some residual risks. And I think when I think about any portable alpha strategy, the concept of alpha is relative to the risk that you've removed, assuming that you caught all of them. And so I think that it's a great framework as a start. And I think what made it challenging for investors is they really thought perhaps that they were segregated and there wasn't risk in the alpha. And I think, the concept makes a lot of sense. And I like the concept of, using the value of implicit leverage that you get in derivatives, which allows you to get sort of more capital efficient use of your capital, aka you can get that equity return and you can combine something with it. But what I do like with the paper, regardless of the terminology, is that, I think the more and more that investors understand that managed futures and equities is just a very natural complement, the better. But they also need to understand the risk. And what I mean by that is the correlation risk. So there can be periods of time where managed futures doesn't look like alpha at all, where it's actually long equities. And that would actually increase your exposure if you had a recession or a drawdown. And so I think that if you call it portable alpha and someone really thinks it doesn't have correlation risk, then there's risk that they will be disappointed or upset in certain periods. So yeah, I don't know. I mean, you probably agree with me, but
no,
so.
absolutely. I mean, I scanned through the aspect paper. Was there anything in the paper that kind of stood out from your perspective? I mean, I think a lot of it is around what we're talking about. That it matters how what's your alpha source, what's your beta source, and how you blend them. That's obviously the key ingredient. Any other takeaways would you say from the paper?
Well, I just like that they're kind of highlighting the capital efficiency of futures, because I think that, the word leverage is often, it's seen as a bad word a lot of times, especially by equity investors, because they really think about that you have to borrow something. And, and what's great with futures is implicit in that leverage, you don't have the borrowing costs associated with it, and you can still just have capital efficiency. So it is a way to combine, and I'm a big fan of combining equities with trend and other, managed futures strategies, because they naturally work well together. So you get a package, which basically is a little bit smoother as a global portfolio, as opposed to just, you still get that equity exposure, but you kind of smooth the ride with something that's a little different.
Yeah.
So.
I mean, there is a curious kind of topic or debate here. I mean, it's true. We all know, combine equities and trend following, you get a better Sharpe. But that suggests that, why don't trend followers just stick in a constant long, 100% S&P future and then modulate around that? Obviously, there are reasons, but I mean, that's effectively the same thing, isn't it?
Well, I mean, it's just, I think we're going to see more and more product in those areas, just because the question is much more of a packaging question, I think, for people, because they have equities here over on the left and, they add managed futures. And so they need to do that combination themselves. But I actually do believe combining them together dynamically, just like the risk management we saw in that paper, has some concentration help, right? So making a parallel to Quantica is that if you include equity exposure with, I think the challenge is always complexity, right? Like the more complex a product becomes, the harder it is for investors to understand, performance over time and expectations. And so it's going to be, as we, see more of those type of products in our space, there's going to be a lot more work that's going to have to be done by people like me. So this is fun to educate people on, the benefits of combining equities with trend.
Yeah, well, one of the reasons why this is popular again, there was a Bloomberg article I was chatting, I think it was Andrew Beer a few weeks ago, around this, and the Bloomberg article was saying part of the reason for the resurgence of portable alpha is it's hard to sell an alternative product in an environment where the S&P is doing 25% per annum, kind of on with the implicit assumption that it will continue to do that. You can debate that, but I mean, investors, they often have this perception, okay, there's going to be an opportunity cost if I take money out of the S&P to put into an alternative. So this is a nice solution. I mean, do you get that in your conversations with investors, that they don't want to go into an alternative because of that perceived opportunity cost?
Yeah, I mean, I think that's the classic debate. I mean, I'm sure you're talking with Andrew Beer about this as well. It's like, if we move from the 60-40 to the 50-30-20 or whatever, there's an implicit view from investors that, kind of there is this opportunity cost of switching to something else. And I think what's exciting about the framework of portable alpha, with the caveats that you understand that correlation risks exist, it's a way to kind of say, instead of sourcing from pulling out of those two classic buckets, maybe you can just kind of add something that has alternative features that's similar to that bucket. And so that's very desirable, I think, for investors who still want that equity exposure, but want something else that maybe likes macro environments a little more. Or if they're nervous about bonds, like, what bond alternatives do they have? And they still stay with their 60-40, but they provide some alternatives that have similar features.
The other question that you get with this kind of product, I guess, is where does it sit, in the portfolio? Because lots of, bigger institutions will have different teams and it's all kind of bucketed off. You're the equity or you're the beta analyst and you're the alternatives. So when you combine different kind of return streams and you get a hybrid type product, where does it sit? Or what's your perspective? Or what would you say to investors on that?
That's the precise problem, right? So if you have equity plus other strategies, is it in the equity bucket or is it not? Or is it closet equity in your alternatives bucket? So, I think that's kind of the challenge. It's the way that people classify those investments. And so that requires a reframing for investors. And, if I want to use an example where I think is really great, my favorite example is what some of the pension funds have done with risk mitigation strategies. There's an example. They created a bucket which, had a specific mandate, and then they could articulate to their portfolio teams and their boards, like, this is the goal of this strategy. And then they were able to put something in things like trend or, long vol. And so I think the challenge with any of these combined products is exactly like you say, does it really go in the bucket or does it have its own bucket? And those are that creates some challenges for explanation and for attribution. And then once it's in the bucket, guess what? It gets compared to the things in the bucket. So, it makes it challenging for investors.
I mean, is it equity plus or is it, absolute return or, so that tends to be one of the challenges. But I mean, you would think of all of the strategies that lends itself well to this kind of construct, trend following managed futures would seem to be one of the strongest. I mean, have you seen, people talk about 130-30 where, you're long 130% equities, short 30, still have 100% net. And that was kind of one of the popular ones back in the 2000s. That seems to be having a bit of a resurgence. Anything else obvious lends itself to this kind of approach, would you say?
I would say that would definitely be one that's a natural candidate too, because you're also seeing if you've been watching the momentum factor this year and some of the factors, I think that dispersion across equities, both globally and in the micro level, has created a lot more opportunities. So that would be a way to kind of enhance your, using cross-sectional adjustments to enhance your overall beta. So I think that is one natural candidate as well.
Yeah. And you touch on the risks of this approach. And obviously, one of the risks is with trend following, adding it to equities, you've got equity positions in your trend following. And, at certain points in time, I guess at the moment, trend followers would generally be long equities, so which is not a bad thing because you're capturing the trend. But at some point, there will be a turning point. So it also lends itself to the question, and I know some managers have done this, of tweaking then the trend following program. If this is the objective is to blend it with equities, would you tweak the trend following program either to cap the equity beta or to be faster to turn down in equities? Or what are your thoughts on that?
Yeah, I've done a lot of research on that, and there are definitely several different methodologies you can use. One is sort of the sizing of trend can also be something that's dynamic. So, for example, depending on so then it's a portfolio question, right? Like how correlated is trend and managed futures? You could think about that. Other managers have looked at things like beta capping equity exposure. There's a lot of things that you could do to try and optimize that relationship if you wanted to. Or you could just kind of accept and clarify that, these things are moving independently and occasionally they'll be in the same positions. And I think there's a range of different approaches to that.
Yeah. Yeah. I think that's the, it comes back to kind of the investor utility function. And if you're willing to, because obviously you will get some months where both equities and trend following have a tough month, and then you're going to have a particularly tough month with a portable alpha strategy. So yeah, I guess that just comes with the territory. You have to be able to live with that kind of volatility.
Yeah. I guess it's about communication, understanding the product. Again, where I pointed out that complexity makes more work for us to make sure that everybody is really, clear of the risks.
So, just before we're coming up close to the hour, before we wrap up, obviously it's year end. You're looking ahead to next year. Any thoughts? We did touch on it a little bit earlier on in terms of some of the themes. Obviously, from we're seeing a lot of evolution in the landscape, as you say, more ETFs being launched at the same time. The macro environment is turbulent. It's interesting. So you would hope and expect there to be opportunities from a market perspective. What do you think will be when we're sitting back here in a year's time reviewing 2025, what do you think the things will be that we'll be preoccupied with?
So when people have asked me what are the biggest concerns I have going forward, or the biggest risk and that people are underestimating, and I've generally said the volatility of inflation. Not just the level of inflation, but really just this idea that, we think that it's gone and then it comes back. And that's why this month has been interesting to me. And I think really nobody knows yet, what, especially for the US, what is this deficit situation? What are these policies? What is going to be pro-inflationary and what isn't? Where is the ballast going to swing? And so I think that's something that, we're all a little bit burned from what happened in 2022 and 2021. So, just because inflation is compared to other aspects of finance, inflation goes all the way to the core. It creates political uncertainty. It makes people uncomfortable. And it doesn't just make us on Wall Street and trading uncomfortable. It makes everyone uncomfortable. And it really creates a lot of socioeconomic problems. So I think that inflation is something not to ignore, and something to worry about. So then by that proxy, I think bonds are going to be hard. Bonds are hard. They used to be the favored child of managed futures for decades. And now they are sort of the least favored child, I would say, from my perspective. Because bonds have no natural predators except for inflation. So, and now we have inflation that's kind of coming in like the coyote, chasing after your bonds. And so I think that's an interesting one to watch next year. And I think everybody's going to be watching also. I'm just interested to see, how does this pro-US theme, can it keep going? How does China pivot and sort of adjust to it? How do other regions kind of navigate where, I just find it so fascinating. The US is the slower one to cut rates. We're never, that's not a usual, they're usually leading, and now they're lagging, right? And they're being slower because there's just such a different macroeconomic situation in the US versus others. And we haven't had this divergence in most of our careers, right? So it's an interesting time.
Definitely, and absolutely. And we have the uncertainty of tariffs. Will we get them or not? And then the additional, what impact it will be. Will they add to inflation or not? Lots of different views on that. And then, as you say, not inconceivable. I know it's not expected at the moment, but if you did get tariffs, if you did get animal spirits being unleashed in the US and the Fed had to turn and start to tighten again, and the ECB at a point of easing, that would be really unprecedented in our careers. I'm sure if you go back to the 1990s, 1980s, it happened, but certainly in the last kind of 3 decades to have the US and Europe on divergent monetary policy paths, that would certainly be unprecedented and hopefully gives opportunity. But as you say, on inflation as well, we had the inflation numbers out this week and still kind of showing a little bit of stickiness. Not running away to the upside, but certainly been slow to converge on the magic 2% level. So I think that's definitely important. But interesting. At the start of 2024, everybody was talking about how many millions, billions of people around the world were going to the polls and expecting a lot of concern about elections. And, we've got through 2024. It's all gone pretty smoothly, you would say. So, it's interesting times, but hopefully it'll be volatile without being volatile in a good way.
I hope so too. 2025 sounds like a great year, so I'm excited about it. Yeah.
Good. Well, good stuff. Well, great to chat with you. Enjoyed speaking with you today. So next week, I believe we're releasing the first of the two groups sessions. So for listeners, stay tuned to that. We recorded in early December, and we had the full complement. No technology challenges. Everybody managed to log in and record okay. So hopefully that comes out well. So for the next 2 weekends, you'll have the group sessions before we're back to normal in 2025. So we should probably wish all our listeners a happy holiday season, and we'll talk to you in the new year.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.